Imagine a world without Google. There's no search, no YouTube, no maps, and no Gmail. And feels hard to picture, right? But even giants like Alphabet, Google's parent company, face challenges. And today we're diving into three major risks Alphabet is navigating. But despite these challenges, 31 super investors still own the stock. And honestly, I regret not buying more. Alphabet is one of the most beloved stocks among super investors. According to the latest filings, 31 super investors hold Alphabet in their portfolio, making it the most second owned stock in this elite group. One standout is Lilu Himalayas Capital, where 17% of his portfolio is dedicated to Alphabet. That's a bold bet on its future. In fact, it's the second most owned stock by super investors. But why? Because Alphabet isn't just a search company. It's a tech powerhouse, pioneering AI, self-driving cars, and quantum computing. Alphabet thrives in dynamic and fast-changing industries. The first one is digital advertising. The digital advertising market is rapidly expanding, projected to reach $1 trillion with Google, Meta, Amazon, and YouTube together commanding more than 50% of the global market share. Google Search is contributing $192 billion in revenue over the trailing 12 months in 2024, 13% year-over-year increase. To be a leader in an industry is great, but it comes with issues. In fact, the first major risk is that Google is currently facing significant antitrust scrutiny in multiple jurisdictions, which could impact its operations. Notable developments include United States. In August 2024, a US district court ruled that Google violated antitrust laws by maintaining monopolies in online search and search advertising. The Department of Justice is considering remedies, potentially including the divestiture of assets such as the Chrome browser, Google Play App Store, or Android operating system to restore competitive conditions. And that is insane. It's a practice that every company as its scale is doing, right? And the same does Visa in its industry. Every company that has a monopoly is a target. In September 2024, Europe's top court imposed a 2.4 billion euros fine on Google for abusing its dominance in the shopping comparison market. Additionally, the US Digital Market Act, enacted in July 2022, targets large tech companies, including Alphabet, to ensure fair competition and may impose further obligations on Google's operating within the EU. And the most recent one is United Kingdom. In January 2025, the UK's Competitions and Market Authority (CMA) initiated its first investigation under new digital market rules into Google's search and search advertising business. The CMA aims to assess whether Google holds strategic market status, which could lead to mandated changes in its business practices to promote fair competition. The second industry in which Google is a third player is cloud computing, a significant growth driver, actually the second, with revenues of $40 billion, up 35% from previous year. Google has invested a lot of money into the infrastructure, so this is why we can see a bump into the expenses. Alphabet has delivered a total return exceeding 160%, demonstrating its ability to create long-term value for shareholders. In third quarter 2024, Alphabet reported revenue of $88.3 billion, marking a robust 15% year-over-year increase, driven by growth across key segments like digital advertising and cloud computing. And the net profit margin consistently exceeds 25%, while the ROIC, return on invested capital, delivered impressive performance, underscoring its ability to allocate capital effectively for sustained growth. It's around 33%. Cash reserves. The Alphabet maintains significant cash reserves, offering flexibility to pursue strategic investments, R&D, and acquisitions. And it deploys strategically the free cash flow. In 2018, they have started to repurchase many shares. And recently, they have started the policy to pay dividends, and now the dividend yield is around 0.31%. The payout ratio is 7.86% and the free cash flow payout ratio is sitting around 13.18%. In 2020, they tripled the debt they had on the balance sheet, but that is not a concern if we take a look at the ratios. For example, the debt to equity ratio is 0.05. Now let's take a look at the valuation. The company's market capitalization stands at approximately $2.4 trillion. It's trillion, right? Not billions. Alphabet's trailing price to earnings ratio is around 26 and the forward P ratio is around 22. And this indicates expectations of earnings growth. In fact, while Alphabet's current valuation reflects strong financial metrics and positive growth prospects, there's the second risk: advertising market competition. ChatGPT is influencing user behavior, with some individuals, including yourself, myself, opting for ChatGPT over traditional search engines like Google. Comparing ChatGPT and Google revealed that users perceive ChatGPT's responses as having higher information quality, leading to better user experience in terms of usefulness, enjoyment, and satisfaction. And in response to these developments, Google has integrated AI-generated answers directly into its search results through a feature named AI Overviews. Initially tested in the UK and US, this feature displays AI-generated summaries at the top of the search page, aiming to enhance user engagement. This trend underscores the need for Google to adapt its strategies to maintain its position in the evolving digital landscape. And the third risk is the dependence on advertising. In the first 9 months of 2024, advertising accounted for approximately 87% of Alphabet's total revenues. This heavy reliance underscores the company's vulnerability to fluctuations in digital advertising market. Despite overall revenue growth, there have been instances where advertising revenue did not meet expectations. For example, in the fourth quarter of 2023, Alphabet reported that revenue from its core search advertising business fell short of analysts' estimates, overshadowing an otherwise strong end to year. Such occurrences highlight the potential impact of ad market slowdown on Alphabet's financial performance. And I love dividends, but I like to see Google reinvest into Google Cloud infrastructure and AI. So, would you prefer Alphabet to pay dividends, or do you favor their focus on reinvesting in growth and buybacks? So, write the comment in the section below. From a technical perspective, Google is trading at above its 50-day moving average and also 200 moving average, signaling positive momentum. However, it's approaching a resistance level near $200, and a breakout above this could indicate further upside, while a drop below $190 might suggest short-term weakness. Alphabet is a company that's shaping the future, thriving in dynamic industries and delivering strong financial performance. But with great opportunity comes great risk, right? And these are regulatory changes, ad competitions, and reliance on advertising are real hurdles. So still, with these 31 super investors baking it, I'm confident in Alphabet's ability to adapt and grow. And yes, I wish I would bother more. If you enjoyed this breakdown, don't forget to subscribe, like, and share to support my channel, and let me know your thoughts in the comments below. Thanks for watching and see you in the next one. Bye bye.